Hello and welcome back to the channel where we break down complex market dynamics into actionable insights. Ever wondered what makes a stock hard to borrow and why that can sometimes signal a potential short squeeze? Today, we're diving deep into a fascinating case, the Grow Hub Limited, trading under the ticker TGHL. The stock recently popped up on our hard to borrow screener with some truly eye-watering numbers, and we're going to explore what these numbers mean for traders and investors. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with a quick profile of TGHL, the Grow Hub Limited. This company operates in the technology/software infrastructure sector, providing product traceability, data analytics, and product trading facilitation solutions both in Singapore and internationally. With a modest market capitalization of $16.02 million, TGHL is a relatively small player, which often means its shares can be more volatile. Chart TGHL 30-day price. Looking at its recent price action, it's been a roller coaster. Today, TGHL is up a respectable plus 9.20%. However, if we zoom out, the last 5 days have seen a significant pullback of minus 38.37%. Yet, over the last 30 days, TGHL is still up plus 15.91%. Highlight price movement in terms of volume. Today's trading saw around 1,119,900 shares change hands, which is quite a bit lower than its 30-day average volume of 10,157,840 shares. This gives us a relative volume of about 0.1x average, suggesting today's bounce happened on lighter trading than usual. What is cost to borrow and why it matters? So, what exactly is cost to borrow, or CTB, and why is it so crucial for understanding a potential short squeeze? When short sellers bet against a stock, they first need to borrow shares from a broker, sell them, and hope to buy them back later at a lower price for profit. To borrow those shares, they have to pay a fee, much like paying rent for an apartment. This fee is the cost to borrow, and it's typically expressed as an annualized percentage. In a healthy market, this fee is usually very low, often under 1%. But when a stock becomes hard to borrow, meaning there are very few shares available, that fee can skyrocket. A high CTB indicates that demand to short the stock is strong, or more importantly, the supply of shares available to short is extremely limited. Short sellers have to weigh that daily cost against their conviction that the stock will fall. Why this stock is hard to borrow right now? This brings us directly to TGHL. Our screener flagged the Grow Hub Limited with an absolutely staggering annualized cost to borrow fee of 773.1%. Highlight 773.1%, that's not a typo. Imagine paying over 770% per year just to hold a short position. For context, typical CTB is often below 1%. This tells us that borrowing TGHL shares is incredibly expensive, suggesting a severe scarcity of shares available for shorting. While the exact number of shares currently available to borrow is unknown, a CTB fee this high almost always implies extremely low availability. The estimated float for TGHL is 12.7 million shares, which isn't tiny, but a concentrated short interest could quickly gobble up the available borrowable shares. Our internal composite squeeze score for TGHL, which combines various factors like CTB, volume, and technicals, currently sits at 46.5 out of 100. This is a moderate score, indicating interesting potential but by no means a guaranteed squeeze. It's crucial to remember that a high cost to borrow doesn't automatically mean a squeeze is imminent. It can also signify that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to maintain their positions. Squeeze mechanics explained. Now let's talk about the mechanics of a short squeeze. A short squeeze happens when the price of a heavily shorted stock starts to rise rapidly. As the stock climbs, short sellers begin to incur losses on their positions. More critically, they are also paying that exorbitant cost to borrow fee daily. This dual pressurizing price and high borrowing cost can force short sellers to cover their positions. To cover, they have to buy back the shares they initially sold. This buying action creates a surge in demand, which in turn pushes the stock price even higher, trapping more short sellers and forcing more covering. It creates a domino effect, or a squeeze. For a stock like TGHL with a relatively low average daily volume today, 0.1x relative volume, any significant influx of buy orders from short covering could potentially lead to sharp price movements due to the limited liquidity. Dilution risk check. One critical factor that can negate even the strongest short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of outstanding shares. This can flood the market with new supply, making it easier for short sellers to find shares to borrow or even for institutions to sell, effectively offsetting any buying pressure from covering shorts. When new shares hit the market, they dilute the value of existing shares, which can crush a stock's price regardless of its short interest. For TGHL, we checked for recent dilutive SEC filings such as -1s, -3s, or 424Bs, and found no such filings in the last 90 days. Furthermore, there have been no recent reverse splits for TGHL in our look-back window. This is a positive sign for any potential squeeze scenario, as it suggests the company isn't currently adding new supply to the market that could undermine a squeeze. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're tracking TGHL, what should you be watching? First, keep an eye on price action. Can TGHL maintain or build upon today's plus 9.20% gain, or was this just a dead cat bounce after its minus 38.37% dip over the last 5 days? Second, watch the volume. A true short squeeze usually involves a significant increase in trading volume as shorts scramble to cover. A relative volume much higher than today's 0.1x average would be a key indicator. Third, continue to monitor the cost to borrow and any potential data on shares available to borrow. If the CTB remains extremely high or climbs even further, it adds pressure. Given TGHL's estimated float of 12.7 million shares, if a substantial portion of that is already short, and borrow rates remain high, any upward momentum could become amplified. Remember, our composite squeeze score of 46.5 is moderate, not extreme, so continued vigilance is key. The GrowHub Limited TGHL presents a fascinating case study in the world of hard-to-borrow stocks, particularly with its eye-popping 773.1% cost to borrow. While a high CTB doesn't guarantee a short squeeze, it certainly puts TGHL on the watch list for anyone interested in these unique market dynamics. Understanding the pressures on short sellers and the potential for a chain reaction is crucial for grasping these situations. Keep learning, stay informed, and always manage your risk. If you found this breakdown of TGHL insightful, please hit that like button, subscribe for more in-depth analyses, and let us know in the comments if there are other stocks you'd like us to put under the microscope.